Matthias Busch. Then it will be Paula Beltran from the IMF, Matthias from Sessão, Paula Beltran from the IMF will comment on that paper, and in sequence will present a lending network under stress. Such paper will be debated by Douglas Araújo from BIS, and next he will present supply chain transmissions of climate-related physical risks. So presenters will have 20 minutes. After that, we'll have a discussion of up to 10 minutes. And right after the discussion, we will collect up to 2 questions from you, the audience. And then the original presenter of the paper, the author, will comment on the discussion and answer the questions. We expect to have around 40 minutes for each paper, 2-hour session. We are already running a little bit late, but we are starting under this 15-minute tolerance. We're starting now at 2. We should go until 4. Thank you all, the presenters, for submitting your papers to this conference. I want to thank you in the name of the Central Bank. And, well, the floor is yours. Let's start. People want to hear from you. Matthias, please.
So, this is working? Yes. Hello, everyone. Thank you, Ricardo, for the introduction, and thank you also to my fellow panelists in the session. I'm looking forward to a fruitful discussion with you, and thank you for coming after this lunch. I wanted to thank, obviously, the organizers for hosting us. I work at SEMLA. SEMLA is the Association of all the Central Banks of the Americas, and the Central Bank of Brazil is an important member of SEMLA, so I'm particularly happy to be in one of our core members visiting. This is joint work with my colleagues Ricardo Correa, he is at the Fed board, Andrea Fabiani from Banca d'Italia, and Miguel Sarmiento, who is at the Central Bank of Colombia, Banco de la República. And in the paper, what we're going to ask is a topic that became quite topical after we just started working on it, namely, how do global supply chains reallocate when we have political shocks, as for example, tariff shocks, like the one we have been seeing unfolding this year? But most importantly, how those reallocations of supply chains are financed. What's the role of the financial sector in fostering or limiting the way these reallocations of global supply chains occur? And before giving you an introduction to the exercise that we implemented, let me show you 2 graphs. One of them I'm pretty sure you are going to be familiar with. The other one, maybe not that much. The graph you see behind me on the left-hand side shows this well-known Baker and All policy uncertainty index, particularly trade policy uncertainty index, and the red line, so the right-hand side tail in that curve, shows what has been happening since the election of the second Trump administration at the end of last year. So it's a massive jump, basically, in this indicator, which is coincidental with the introduction of trade tariffs in the US, mainly across China at the beginning, but as you know, this has been evolving in a very rapid way since then. On the other side, on the right-hand side of the panel, you see a figure that for us was kind of surprising when we saw it. You see first a black line with the US imports that are channeled from Latin America as a whole. Importantly, these are not all imports from Latin America, but particularly imports that can be attributed to be part of a global supply chain. That means practically that these are inputs that when they reach the US, they have before crossed at least 2 different borders. So it's not that they came directly from Brazil, they came first from China, then to Brazil, and then to the US. And if you look at the numbers, the share of these global supply chain imports in the US, you see that those that come from Latin America have been increasing dramatically, even since before the first Trump administration. And interestingly, the red line shows you that the same US imports attributed to global supply chains, but coming from Asia, have been decreasing. This is obviously a very visual way of showing you how global supply chains reallocations occur and unfold. And these numbers are massive. If you track this down to, for example, balance of payments data or FDI in countries in Latin America, you've seen in cases like Mexico and Colombia, how the FDI, the foreign investment, particularly of Asian investors, have been increasing dramatically. So we want to understand whether we can indeed attribute part of this reallocation to tariffs that are imposed in the US against trade partners. And second, we want to understand how this relocation is financed. So we will examine the role of cross-border credit, both coming from banks and from firms, so two different agents, and ask if they play a role in supporting this reconfiguration of supply chains that we are observing as we speak. Two key questions here are first, if exporters in a bystander country, this is a country that is not directly involved in the trade wars, in our case will be Colombia, pick the slack and increase exports to the US. So we are going to try to use super granular data to try to pin down if a Colombian exporting firm increases its exports to the US in product categories that have been subjected to tariffs from the US against other countries, for example, China. Okay? So it's a kind of nearshoring effect. And second, we will ask whether cross-border credit, either from banks or from firms, plays a role in this dynamic. So this is basically the idea. Important note here on the literature is that probably many of you are familiar with this. There is a lot of evidence actually that global banks play a role in supporting trade. This has been shown at the macro level, at the micro level, with different sorts of countries, different global data sets or local data sets. And all of this makes sense if you think about the keynote session that we had in the morning, right? Professor Tirol was highlighting that banks are special in certain ways, right? They play a special role. They have certain advantages to manage information asymmetries and market frictions in finance. And this is exactly what we see in this, reflected in this literature. What we see is that banks have an advantage in supporting trade because they can manage the information that is needed to provide credit to different parties located in different countries. They also have the size and the scale. They have access to foreign currencies, right? So there are many reasons why we will think banks play a role in this dynamic. Now, what we will show, and this will be our contribution in this paper, is that if we are in a situation of a large-scale trade war, where we see global trade going down, then the frictions that are relevant for firms are not the usual ones, are not these ones like information asymmetries and things like this, but mostly the fact that they need to keep the supply chains going. And for that, what we find is that the main partner will not be a bank, it will be actually a firm. And the Colombian exporters will source their financing to increase their exports abroad from US and other foreign firms rather than from banks. And that's a new phenomenon that has not been documented before. What you see here in this graph is basically the share of Colombian exports that correspond to products or product categories that were eventually subjected to tariffs from the US against China in the period from 2018 to 2019. So we are taking here the values of Colombian export fixed as of 2017, just to clarify the exercise. And then we ask over time, and that's why you see that this reaches like a steady state at some point, we ask what is the share of all those exports from 2017 from Colombia that eventually became part of this trade war that initiated in 2018. And the numbers are quite massive. So 30% of total exports, excluding commodities, were part of this global dynamic, at least in this case of Colombia. And if we focus on the exports to the US, we see that 4% of exports of Colombia to the world, which is quite sizable, were part of these products that eventually became subjected to tariffs. Tariffs where Colombia didn't have any say, right? We're talking about tariffs of the US against China. So this is the idea that we're going to exploit. Now, I know that this is a big picture and you will not see the individual countries, but that's not my purpose. I just want to give you a very kind of simple snapshot of the type of data we're going to be using. Imagine you are looking at a Colombian exporter firm, okay? And this firm has kind of two relationships, two counterparties. On the one side, that firm is exporting to a certain country. That's what you see on the right-hand side of the chart. On the other side, this firm will be obtaining funding from some source, right? And that's what you see on the left-hand side. So the chart is basically connecting where the funding for Colombian exports to the rest of the world is coming from. And the chart is amazing because it shows you that the funding for this export business of Colombian firms comes from everywhere, including Brazil. For example, Brazil is a very large partner in this. There are also very interesting connections. For example, we know from this data to give you a local example, being here in Brazil, that a sizable share of the exports from Colombia to Brazil, so in that direction, are funded by Spain. So there are Spanish firms funding Colombian exporters that are doing business in Brazil. And we dig deeper into this. If you want to know the anecdote, this is basically fashion companies like Zara, who are sourcing their production in Colombia, providing the funding from Spain for products that are actually meant for the Brazilian market. So it's a very complex structure. This is not completely under the radar because it's captured in the balance of payment statistics of all countries, but it's not really captured in micro data sets like the one we have here. What I'm going to go through in the minutes I have, the timer is not there anymore, but I see your computer, so maybe I can keep it. So I will briefly explain the research design and the data, and then walk you through the main results, just the most important ones, and then conclude. So we will follow two steps here in the analysis. First, we will adopt a diff-diff model to account for the effect of certain products that are being subjected to tariffs in the US against China. And we will ask if those tariffs have an effect in how Colombian exporters behave in terms of their trade flows to the world and to the US in particular. And we will control for global demand in those products, right? So we want to pin down a very specific supply side effect here. And second, we will exploit this setting in order to understand how this reallocation of global production is being funded. Two diagrams to visualize what we have in mind. So first, what you see here is, and I'm lucky that we use Brazil as an example, which is not prepared for this conference. It's just a coincidence. So imagine you have two destination countries, the US and Brazil, and you are a Colombian exporter. You have firm A and firm B. And both are producing two goods, pineapples and machines. Yeah? So very simple producers in Colombia, and they export to the US and export to Brazil. Now imagine that only one of those product categories, in this case machines, are subjected to tariffs that are imposed in the US against Chinese machines. This has nothing to do with Colombia, okay? So what we are going to compare is whether those firms that are particularly active in the machine business, in machine trade, see an increase in their exports, in their trade to the US, following tariffs imposed in that particular product category, right? And we will have two comparison dimensions. First, we will compare products, and then we will also compare across destinations. This is the model. On the left-hand side, we will have exports at the firm, product, country, and month level. And on the right-hand side, beta 3 will be our main coefficient of interest, which captures the interaction between a post dummy that is product and time specific. So it's a kind of staggered design if you're following this. And it's interacted with a US dummy that defines whether the destination of this export flow was the US or not. Obviously, this is important because the tariffs were imposed in the US, right? And we are going to saturate this with a bunch of fixed effects to try to isolate the supply side effect. Once we do this, we will move on to the credit part of the story. And here we will take a different approach. We will consider again two firms. One will be highly exposed to trade wars, and the other one will be exposed to a lower extent. So basically this will depend on whether a firm was exporting machines before the tariffs were imposed. If a firm was already in that business, then we will assume that firm is exposed for our definition, right? And we will expect that firm to increase its exports. And in this second iteration of the model, we will ask how the funding for these transactions is being channeled. Does it come from cross-border bank credit, cross-border trade credit, so firm-to-firm credit, or domestic bank credit? And we will compare all those three. So that's the intuition. For this, we will compute an exposure metric. This is a very simple metric that simply tells you what is the share of those products that a firm was exporting in 2016 and 17 that eventually became subject of tariffs in 2018 and 2019. Okay, so the idea is to have a pre-existent, predated exposure that tells us whether a Colombian firm is in a position, ex ante, to benefit itself from the trade wars. And then we will run this specification where we are estimating credit variables on the left-hand side at the firm, lender, and time level, in this case quarterly, and we will focus the identification on beta 3, which is the interaction again between a post dummy, which is specific to each firm, and the exposure. So the data comes from four main repositories, which is basically trade repositories, tariffs that were collected from the US International Trade Commission, and 2 credit registries. One is the credit registry you also have here in Brazil, and you are probably familiar with. This is the domestic credit registry. The second one is the innovation in the paper, which is a credit registry that captures from different sources the extent to which a Colombian firm is obtaining funding from abroad, from non-banks particularly. Okay? So this is kind of the new part of the data set. So here you see some descriptive statistics. Indeed, there is some evidence, at least on the average. This is the red curve of the US, of the products being affected by tariffs, having more exports from Colombia to the US, but we will try obviously now to test this empirically. And let me walk you through the main results. So first, we have our core specification on trade reallocation. This is at the product level, so product firm level. And what you see in the red numbers that are highlighted in this table is that following the introduction of a product-specific tariff of the US against China, a Colombian firm that was active in that product category will increase its exports to the US. Actually, it increases exports all across the border, but particularly to the US. This is sizable if you make the calculations. The implementation of tariffs increases exports in a magnitude that corresponds to around 15% of a standard deviation in the export variable. So this is a quite large effect that we pin down here, and this is reflected either in values of exports or in quantity of exports. You can do both and you get similar results. They are more robust for volumes than for prices. Second, we replicate the same exercise at the firm level, finding similar results. So namely that if we aggregate our product level data at the firm level we see that an imposition of tariffs in products that are relevant for a firm lead to more exports. And as you see in column 4, this is particularly significant for firms that were active in the US market ex ante, which is in coincidence, right, with trade theories and evidence in terms of how your market presence plays a role in terms of exploiting market opportunities like the one arising from the trade wars in 2018 and 19. Very important question is whether this is reflecting simply a reallocation of Chinese production, right? So the main story probably many of you are thinking now is that these results I'm showing you simply reflect the fact that Chinese producers are now not exporting directly to the US, but actually indirectly through Colombia, right? And that's indeed one possible explanation for what we find. So to rule out that explanation, we run the same specification, but looking at imports from China to Colombia, and we don't find any results. So these firms that are exporting to the US and leveraging on the fact that they can exploit the market opportunity of the trade wars, they were not receiving more imports from China. So it's not a triangulation of production, the one we have here. And importantly, we also see that these firms see an increase in real outcomes, for example, in investments and working capital. So it's not just a repricing of their products, it's really a rescaling of production. So they are investing more, they have more working capital, they export more, and all of these numbers are very significant when you look at the economic magnitudes. To go to the final part of the paper, we are going now to ask how is this reallocation of production being funded and where is the money coming from? This is a question that has not received much attention. There is some evidence in the US for the domestic market, but not on a cross-border dimension. What you see here in this graph is a representation of what we call exposed firms versus non-exposed firms. So the dashed line are non-exposed and the solid line are exposed firms. And we see that for the case of firm-to-firm credit, this is credit that is coming from a US company, non-financial company, to a Colombian exporter directly, okay? So this funding, which tends to be quite actually large in terms of maturity, so it's not short-term funding, it's not the usual trade funding that we see around, was much more stable and actually it was growing for exposed firms, whereas it was decreasing for non-exposed firms. So let's try to test this empirically. When we do this, we find the following 3 main results. First, we find that those exporters that were exposed to the trade wars by being active in these product categories, as I mentioned, they get more loans from domestic banks at better terms. So interest rates go down, maturities are extended, and the volumes of the loans increase. This is already quite nice. So we see that local banks are stepping in. Second, we look at foreign banks, and we find that actually foreign banks are retrenching from this market. So they lend less at higher rates and at lower maturities. All of this is significant. So it means that they are moving out of these regions, which is in line with evidence in the US about US banks not being willing to participate in trade during this uncertainty period in 2018, 2019, which happens locally and abroad, as we document. And finally, the most interesting result, at least from my point of view, is that we find that firm-to-firm credit expands cross-border. So that means that Colombian exporters are getting more loans from US firms and firms from other countries too, at better terms, lower interest rates, and longer maturities. All of this is significant. I will not stop in each coefficient in the interest of time, but that's basically what we find. And with this, I think I can conclude. We evaluate in this paper the impact of supply chain reallocations to a bystander country, a country that is not directly involved in the trade wars. And what we find is micro-supported evidence that trade wars are leading to a reallocation of global production, particularly relevant for countries that are close to the US market. And we find this looking at evidence from the 2018-2019 China-US trade wars. We document a significant increase in exports in these product categories that were eventually subjected to tariffs from the US against China. That means a bystander country like Colombia is benefiting in this case from the trade wars. And finally, we find that the financing channel for this process is coming mainly from firms. These are firms mostly in the US, so US-based firms that are paying money, sending money to Colombia so that Colombian exporters can increase the scale of their production and export more to the US to replace Asian-based production. That channel, and that's the final comment, is double as size in magnitude, so magnitude is double as large compared to the effect that we find for domestic banks. So although domestic banks also support exporters, the main channel in terms of size comes from these very pressed and stressed US firms in the urgent need to replace production. And this new channel obviously deserves some attention from a financial stability perspective on the one side, but also from a policy actions perspective, because maybe we should think about how these firms are getting exposed to FX, right, to funding coming from abroad, and to which extent central banks and supervisors keep an eye on this type of funding that has not received much attention in the past. With this, I conclude. Thank you very much.
Thank you for your presentation, Matthias. I now invite Paula to present her comments on the paper.
Thank you for the opportunity to discuss this very interesting paper. In the juncture we find ourselves in with increased trade uncertainty and policy shifts that could reset the global trading system. This paper is very timely and will help us understanding how financing can help support the trade reallocation, notably in bystander countries. So this paper uses very rich microdata, which allows us to identify key channels through a definitive approach. And the key findings are, first, that countries can benefit from the trade war, notably here they show evidence for Colombia following the US-China tariffs. And they also show that there's an increase in investment. This is in line with other papers in the literature, for example, such as the case of Mexico. But here the new key evidence is that trade credit and domestic credit are important in supporting these firms in the reallocation process, despite a decline in FX credit. So let me start by summarizing in a snapshot what are the key results from the paper, and then I'll go through my comments. So first, in the left-hand side, I'm showing you what is the impact of trade tensions between US and China on highly exposed firms in Colombia. And here I'm showing you what happens to a firm that is exposed by one standard deviation more compared to a firm that is not exposed. I'm showing you in the left-hand side what happens with levels of credit. And in the right-hand side, I'm showing you the corresponding interest rates impacts for each type of credit. So what we see in red is that trade credit increases significantly for Colombian firms that are exposed that are in the sectors that are exposed to tariffs, and we see that comes along with a decline in interest rates for those firms. So they are receiving better terms of trade. Now, when it comes to local credit, we see a similar story with important effects in quantities that are typically driven by domestic currency credit. As we see that as opposed as domestic currency, we see that affects local credit, see larger interest rates, as we can see in the right-hand side chart. What is more notable from this chart is that we see that cross-border bank credit declines as a result of the trade tensions, and similarly we see that interest rates increase for cross-border bank credit. So the idea of the paper is to show that in these times of trade tensions, trade credit and local credit are supporting the reallocation despite other sources of funding being less prone to support the reallocation. So my discussion is going to focus mostly on how we interpret the results and how we can explain demand and supply channels for credit across various categories. And then I'll have other comments, notably how to interpret the estimates in the broad literature, identification, and other heterogeneity. So let's unveil the financial channel. So here we see in the right-hand side, we see the results for trade credit. So again, trade credit increases and interest rates go down. While demand can explain the increase in trade credit, so we see in the left-hand side, there's a shift for demand for trade credit. That would explain the expansion in trade credit, but then you'll need a significant increase in supply to be able to explain the interest rates patterns. Indeed, the movement between trade credit and exports is large. Their estimates would suggest a movement of 300%, roughly. So this means that indeed trade credit is increasing a lot when it comes to support increase in exports. And then on the other side, we do have cross-border bank credit, which is declining with interest rate increasing. So this is in line with an increase in demand, but also in line with a potentially decline in supply. And this is relative supply compared to other firms that are not exposed. So here, I would like to understand better what are the channels to explain these patterns. And I wonder if some mechanisms that can explain these patterns are related to reallocation. One, importantly, toward firms that are less financially constrained into credit and have better or long-term lending relationships. So I would encourage the authors to look at the movement of exports and trade credit at the bilateral level, if possible, to see whether you see reallocations towards pairs with high trade credit levels. And inspect whether firms at different types of financial constraints are explaining these results. So imagine firms that are constrained on both trade credit and bank credit, or firms that are only constrained in bank credit, or unconstrained firms. This may help you explaining the patterns that you see in the data. So you can expand your empirical setting to test for financial constraints and variation across this spectrum. Then also maybe there's a role for effects, notably in a country that depreciated about 20% in the same period. We know from the literature that large firms borrow in effects and act as net providers of trade credit within supply chains. So maybe it would be important to see if this is one channel that can explain the results, notably because FX credit is showing an increase in interest rates. There are additional comments. First, to relate the estimates to broader literature and reallocation. So the cross-country variation does not support export growth in those targeted products. There's this paper by Pablo Fagelbaum and co-authors where they show that in particular in the case of Colombia, at the product level, there is not a significant effect, rather it's negative. They explain it as Colombian products very complementary to US and Chinese products. This paper instead shows a positive impact through the intensive margin at the firm level. And here in your paper, you're showing that perhaps Chinese firms are more of a substitute to Colombian firms. So it would be nice to understand better how identification improves in your setting compared to others, and how to link this to the broader literature. And finally, it would be important to control for Colombia-China interventions, because the period before 2018, there's an increasing new harmful interventions against China in particular. So I would encourage the authors to perhaps consider product-level persistent differences in domestic policy against China in the firm-level regressions. And finally, additional heterogeneity that could be explored. For example, how does the firm position in the global value chains mediate the impact? And how does the firm position also in the financial network matter? And also to explore the perhaps indirect impacts of tariffs. And with that, I conclude.
Thank you for your comments, Paula. Before we give the floor back to Matthias, we'll take a couple of questions from you, the audience. Then Matthias can react to Paula's comments. Do we have questions? The first one here at the table.
Thanks.
Douglas.
Okay. Thanks so much. No, great work. So my question I had is, you mentioned the example of Zara and, for example, Zara in Spain providing financing to presumably some supplier, or even Zara Colombia to sell to Brazil, to Zara Brazil. So my question is, when you look at the microdata, what percentage of this kind of a cross-border trade credit is between a firm and its subsidiary versus between two unrelated firms in the same supply chain? So this would be something I'll be curious about. Thanks.
One more chance for someone in the audience to ask questions. So I'll use one of mine. I'm a more policy-oriented person, so it's less of an academic inquiry. Your estimates come from identification based on sectoral tariffs. And now we are in an environment where the global economic environment is discussing general tariffs on all types of products. Would you rely on your estimates to think about those effects in the current environment, or would you have some bias to think how more general effects should be? How should we be thinking about effects of tariffs over all products from some countries? Should they lead to different results? Feel free to.
No, thank you.
The floor is yours.
Thank you. First, most thank you to Paula for putting this very nice discussion together. This is a new paper, and we are really looking forward to receive some comments so that we can guide better the way we are presenting the results. So I will go through a few comments, Paula, not all of them in the interest of time. So the first one on the demand versus supply. So indeed, I will say that the results that we have so far is more like an equilibrium, right, in the credit result at least. So that means we do have there both demand forces and supply forces. And to some extent, what we have discussed internally is that the fact that we see on the one side the volumes increasing and at the same time the interest rates decreasing speaks for a strong role for demand forces in this setting. Following your idea with the curves. This is not well discussed in the draft so far, so it's something we're working on because it's very important. We are not sure if it's going to be possible to really reach like a more, precise identification of these two forces, telling them apart. But we're working on that, and that's indeed very important. I really like this comment on the financial constraints on firms. You will expect indeed the results to vary across this heterogeneity dimension, depending on whether a firm is ex-ante constrained or not. We have not done that, but the data allows us to do it, so we will take that on board for sure. I also will look at the Fackelbaum paper, which we cite, but we didn't enter into these discussions. Probably there are differences in the sample construction that we need to better describe. I would presume, since we need to match the financial data, the credit data, with the trade data, we need to cut some firms out, and that could maybe be explaining something, but we need to maybe explain better what is going on there. And I just take one more there, which is this idea of looking at the different policies implemented or affecting the relationship between Colombia and China. I think that's very important. We have not looked at this before. So since we are kind of following a sort of staggered design, we thought that the implementation, by being product specific, can sort out some of these local shocks at the aggregate level. But here I will take your comment on board beyond the identification issue and take it more and more as a policy question. Does it matter to look at sectors that were involved in these other policies or not? And that's something certainly that we should explore. So thank you so much. Doug, on the cross-border within firm versus inter-firm, let's call it that way. So we cannot do it directly in the data, but we know this is very important, and we are trying now basically to match the firms by name. But this is a fuzzy merge, so it's not a perfect merge. We don't have an identifier, basically because we don't know exactly, with an identifier, the lender. So we know the location, obviously, that this is, let's say, a US firm. We know all the characteristics of the credit, but since this is a credit registry, we know more about the credit than about the firm. That's the pity in it, but we know this is super interesting, right? So because obviously if you see that this is reflecting intra-firm flows and trades, the policy implications are different, right? And we are looking forward to incorporate that. I think it's a very nice extension. And finally, on the current setting, Ricardo, so indeed, so the main difference with 2018-19 versus now is now we see the tariffs being imposed almost at the country level, against a country, and all across the board, so to say, right? Without distinguishing in terms of product categories. In terms of identification, if you will replicate this paper, it's very difficult, right? Because you don't have this staggered design. That's actually one reason why we focus on this older period in 2018-19. In terms of whether it will affect or not, so our impression, we have discussed this, is that part of this, a large share of this, this movement of changing the location of global production is attributed, in our view, to decisions that were already taken some years ago. So this is an ongoing process that was ongoing despite or irrespective of the decisions of the current Trump administration. And in that sense, probably the results will be not so clear if you find them now, because first you have this overall effect, right, affecting all countries, and on the other side, part of the adjustment that we are documenting here was already triggered by events in the past, and it's a process that will not stop or change materially, in my view, with the current policies. So it's a more structural phenomenon that invites to a different panel, I will say, because it's a much complicated and broader topic. But thank you, very interesting point.
Thank you, Matthias. Since we have 3 minutes still for this paper, one last opportunity for a question from the audience. So thank you, Matthias, for your paper. Paulo, for your comments. Now, Paulo, the floor is yours to present your own paper.
Thank you so much to the organizers for inviting me to present my paper. So let me start with some motivation. Funding dry-ups can create significant distress in financial markets, especially as they rely on networks of counterparties. In this paper, I'll use a quasi-natural experiment from the US money market funds industry during COVID-19. So what we see here is that money market funds in the US dried up significantly at the onset of the pandemic. And here we see that prime funds saw significant withdrawals between February and March 2020, as we can see in the left-hand side chart. And these withdrawals are dislocated unsecured funding markets. Notably because US money market funds, the prime segment in particular, are important lenders for banks, and they provide short-term dollar funding for global banks. We see in the right-hand side that this event also created significant dispersion in prices. We see that the cost of funding increased. So here I'm showing you on the right-hand side, I'm showing you the difference between interest rates and the SOFR across counterparties. We see that the median cost of funding increased relative to the SOFR. And we also see that the distribution widened significantly. So in this paper, I'll ask, what is the role of network frictions in a lending network after a large supply funding shock? And I use the US money market funds industry as a laboratory to test this question, whether network frictions are important. To do so, I will build a model for unsecured funding between money market funds and banks. This model exhibits two key features. First, limited connectivity across counterparties, and second, bilateral market power between money market funds and banks. Then I'll take the model to the data using portfolio data for the US money market funds before the pandemic. And I discipline the key parameters of the model that govern the network effects using a granular instrument that is model-based. And with that parameterization, then I quantify whether the model does or not a good job in explaining price dispersion in March 2020 by taking as given the redemptions we saw between February and March 2020 and see what would be the implications for the model for price dispersion. Then I evaluate the allocation efficiency of the market, and I also assess whether having access to the overnight repo repurchase program for the money market funds is or not an important policy tool. Let me give you some institutional background, because perhaps many of you don't know what a money market fund is. So what is a money market fund? A money market fund is a mutual fund. They invest in low-risk, short-term debt instruments. They are an important source for funding, especially for banks, and they account for about 2/3 of their total portfolio. And the relationships between money market funds and banks exhibit two key characteristics. First, that their relationships are sticky. So first, we see that the median length of the relationship is about 2 years. During crisis, it is very rare to see new relationships being formed. And second, the second characteristic is that these relationships are very concentrated. With, for example, the median top lender's share, it's about 30% bilaterally. And the second key piece of information is that there is significant cross-sectional dispersion that can be explained by the bargaining positions of money market funds and banks. So here we see that cross-sectional dispersion in interest rates can be explained by the bank's exposure and the fund's exposure, with larger banks seeing better rates and larger funds also seeing better rates or higher rates. So let me go, with this in mind, let me go to the model. The model is going to be composed of funds and banks. Funds receive assets under management, and I take those as exogenous, and I'll introduce them in a counterfactual using data between February and March. And funds can lend to banks in unsecured funding. They pick both together quantities and prices, interest rates. Or alternatively, the fund can go to the secure market or invest in the Fed's facility, the ONRP, which is essentially money. So banks demand funding, funds supply funding, and they have all mean variance preferences with respect to aggregate risk. In terms of the network, banks and funds trade bilaterally, conditional on a given network. So the set of counterparties a bank and a fund can trade with is exogenous. However, the links or the intensity at which these links are used is endogenous. So quantities are an endogenous object. The fund faced a portfolio problem, and here are the preferences of the fund, where they balance return and risk. We have two key terms: risk aversion, total risk aversion, and concentration risk, which prevents excessive holdings of a specific counterparty. Banks face a similar problem where they do have a return on asset that is exogenous, and then they also have an aggregate risk aversion, and they pay the fund for funding vis-a-vis their partners. The trading protocol is as follows. Funds, assets under management are given, and then funds choose money on the table to negotiate with their trading partners by picking their positions in the secure market. Then after this is done, for each link there is going to be a pair of traders that negotiate bilaterally in a national bargaining game where they determine together prices and quantities. The relevant outside option is going to be the ONRP, and they trade conditional on the bilateral bargaining power of the fund. There are two key equations. One on the optimal bilateral funding, which balances the marginal benefits and marginal costs, and bilateral rates are going to reflect the bargaining power of the funds vis-a-vis the bank, and reflecting the bank's benefits against their outside option. Finally, misallocation will arise from bargaining frictions, and here there are going to be two opposed forces. One to underprovide, or what I call benefit shifting, which happens where the funds have low bargaining power. In a way, if the fund knows that in the second stage they will have little profits from the relationship, they'll turn to underprovide liquidity. On contrast, if there is a fund with high bargaining power, they tend to overprovide liquidity because they will gain a lot from that relationship. I take the model to the data using data from the money market funds industry, and I complement with some information for banks. For the money market fund industry, I focus on the prime segment, and I used unsecured lending, for which I use commercial paper and certificate deposits. There's a model mapping to the estimation equation. For the sake of time, I'm going to skip a lot of the details, but I just want to show you that we built an instrument to be able to identify some of the key parameters in the model that govern those key elasticities. And this follows the granular instrumental variables approach that is model-based. So here we see in the estimates that first risk-bearing capacity is limited. So here I'm showing you the estimates for the risk-bearing capacity of funds and banks. What we see here is that indeed in the second column we see that the IV shows a positive coefficient, meaning that whenever the risk-bearing increases, there is a tension or a trade-off at the bilateral level for both banks and funds. And I'm going to skip this for time, but the bargaining power is also identified using this instrument. This bargaining power shows that larger banks tend to have better bargaining power, and funds that are more connected tend to have also better terms of trade. So I parameterize the model using the initial distribution of quantities and prices before the pandemic, and I take the key parameters as given, and then I introduce a counterfactual using the observed assets under management between February and March 2020, which on aggregate is about 11% drop. Here is the key result of the paper. What we see here is that funding shocks can explain the increase in the median and dispersion in prices. So in blue we have the distribution of bilateral interest rates vis-a-vis the SOFR, and we see that in red we see that after the shock introduced to the model, we see an increase in the median of about 50 basis points. And we also see a significantly widening in the distribution, very similar to what I showed you in the at the very beginning. The cross-sectional dispersion is also important across banks, and these distributional effects will arise from connectivity. So banks that are less connected, they tend to see larger drops in the supply of funding. The allocation is also inefficient, and here I'm showing you that the plan of response would imply larger allocation of liquidity to banks, especially to those that are less connected. And here we see that indeed, in this chart, we see that the planner will tend to provide more liquidity to overall more banks, to overall all banks, but mostly for those that see severe disruptions in credit. Finally, the ONRP helps improve liquidity, and here I'm showing you the impacts of dropping the ONRP. And the intuition for this result is that the ONRP, having access to this facility, it improves the outside option for the funds, and hence they get better terms when negotiating with their counterparties. And to conclude, here I show you a quantitative framework to measure the impacts of lending supply shock in a lending network. And we see that these network frictions can explain the patterns that we observe during a crisis. And I also show you that money market funds allocation of funding is lower than optimal. And here, this is driven by the bilateral bargaining power vis-a-vis their counterparties. And finally, I showed you that the ONRP is an important policy tool when it comes to liquidity provision. There's also ongoing work, and where, of course, we care about extensive margin and the dynamic problem of network choice. I don't do this here. I'm working on on a paper on monetary policy pass-through through non-bank intermediaries and also frictional repo markets, and this framework will allow us to test these various questions. And with that, I conclude.
Thank you, Paula. I now invite Douglas Araújo to comment on the paper.
Thank you, Ricardo. Thank you, Paula, for presenting your work. Let me now just put in the slides. Okay, hello everyone. So I'm Douglas Araújo, and I'm actually thrilled to present a discussion of Paula's paper, because first I'd like to congratulate you, Paula. I think it's a very interesting work. It's a great paper, and it's actually the kind of work that I like reading, where you first see how the economist thought about the problem, because you actually have a structured model to underpin, to discipline the thinking, and then she goes and puts a model to the data, so it kind of combines the two things that I really like about a paper, and I think she does it very nicely. So Paula's paper, let me just give a brief recap of how I see it, and hopefully if I interpret this right, then I'll offer some comments that could be helpful as you plan to extend your work. So we're looking here at this bilateral funding network, where money market funds, they receive deposits or shares, they sell shares to investors, and they are supposed to invest in like these low risk, short maturity instruments. Some of them are treasuries, some of them are bank issued commercial paper or other unsecured instruments. And then these money market funds, they also have the more recently the reverse repo facility at the New York Fed that is kind of their outside option, virtually riskless. I mean, they're dealing with a central bank directly here. Okay, and they're supposed to fund banks. And what I found interesting about this work is that it's set in, let's say, in a game theoretical fashion. So it's not just a competitive funding where everyone meets in the marketplace and decides one funding for everyone. It's actually a collection of bilateral bargaining efforts that all happens in the same place. So it's the so-called Nash-in-Nash equilibrium. And we're assuming, for example, if I'm bargaining with Paula, let's say she's a money market fund, I'm a bank, I need funding, or bargaining both on the quantity and on the rate. And so our own bilateral bargain kind of in a way depends also on how her own bargaining with other banks is taking place and how my own bargaining with other funds is taking place as well. Because after all, I want to receive a certain amount of fund and funding, and she needs to allocate a certain amount of funding. So the way this happens at the first stage, money market funds, they first decide how much they want to, let's say, stay in treasuries where they have this aggregate risk I mean, we know treasuries are considered one of the so-called risk-free or quasi-risk-free benchmark, and oftentimes they go and explode, as we have seen recently. But usually they're considered safe bets. And once funds decided this, then the remaining available investment is, let's say, as she puts it, is the money on the table that is used to bargain with banks on the quantity and the rate. Okay, and so they are adverse to risk. So they are adverse to both these so-called aggregate risk that bank funding and treasuries share. Both of them are considered to be subject to this aggregate liquidity risk, and to concentration risk, which is actually quite nice because in real life, money market funds also are subject to this concentration limit. They cannot just, buy commercial paper by issuing one bank and just fill it to the brim. They need to diversify in a way. And then she goes and take this model into the data to identify moments of the model. And what she finds that, whenever you have, so the question at hand is, when you have a massive withdrawal of funds from money market funds, like we saw in COVID, Dash for Cash, everyone wanted dollars in their accounts, not sitting in money market funds, for example. So what happens when you have this sudden shrinking of the money market fund universe? What happens to the bladder network, to banks? And then very cleverly using this granular instrumental variable inspired identification, she finds that this lower funding supply leads to a higher rate for banks overall and a higher dispersion as well. And the efficiency of this whole market also suffers from the event. Okay, so this is the model, the paper, how we see it. And again, I think it's a very nice contribution. All of us who work with networks know how hard it is also to take sometimes, theory or how you look at the network to the paper. So I think even the methodological contribution itself is very interesting to me. Okay, now I'll offer some suggestions, as I see it now, and just some overall suggestions that I would like to share is that before going to the more specific comments. So the paper is 70 pages long, which is good when you really enjoyed reading the paper like I did, but for other people who are interested in the takeaways, etc., or maybe just for a general economics audience, it would be nice kind of to stream it down. I think even there's this whole effort in top journals to kind of since 2008, if I recall correctly, to kind of try and keep the lid in terms of paper sizes. And also, the paper does a very good job, as I said, of kind of proposing this econometric technique for network environment. But I would suggest, the paper to more formally pin down why this the strategy that you use to identify the model empirically when you go to the data. Why is it really kind of is it really converging? Is it really kind of a good estimator of the moments you're estimating? Okay, now some specific comments. So first, the main shock that we see here, actually the big shock that we see here is when money market funds shrink. But that does not happen in a vacuum. Whenever this happens, like we had during COVID, for example, the treasury market itself may be in turmoil. And in fact, this is what we saw during COVID. So what I would encourage you is to not only consider the shock of in your model SF, meaning the total amount of funding that money market funds have to bargain with banks when it shrinks, but also when the overall aggregate risk of the market, which includes both banks and treasuries, increases both at the same time. So this could be an extension that you can do, already within your framework, and I would strongly encourage you to do so. So here, just research from BIS colleagues showing that during COVID, during the early stages of the onset of COVID, some 5 years and 2 months ago, there was actually an incredible amount of turbulence in treasury markets itself. Second, the two main forms of risk in the model are aggregate risk, a form of liquidity risk, and concentration risk, meaning that for fund they strongly dislike whenever the fund's share of exposure to a bank is getting high because they have limits to comply with. But I would claim also that overall credit risk is also important during crisis times like the one you're estimating your model on. So here's an example. I just picked 3 large US banks. So this graph is their CDS, their credit default swap spreads. And what we see here over time, and then I also zoom in around the COVID period, is that even though it went down very fast, there was this very strong market movement right around the onset of COVID. And of course, decisive policy helped keep this problem at bay, but I would recommend considering in the scenarios also a scenario where credit risk, meaning the probability that the fund's exposure to the bank will not be coming back to the fund also is taken into consideration. And this can actually, the way I see it, also be done within the context of your model. Because in your model you have, again, the main shock, the total funding amount, SF, the aggregate risk that we talked about in comment 1, but then you also have in your model each bank's asset return. And it's heterogeneous across banks, so you can, let's say, shock everyone's asset return, and at the same time you're also shocking the other two, and then you have a nice credit risk model. At least for me, it would be interesting to see this type of thing. There's a sentence I saw in the Financial Times around the time of the Greek crisis that I really liked. In a crisis period, the return of principal is the return on principal. Meaning, what I would expect to see is that the rate itself doesn't matter so much. It's really about the amount really coming back in, so credit risk. And now lastly, about bargaining power and trading preferences. So in your model, there's this, so I simplified the equation here. The tuple, rate and quantity, is decided by, by how much each fund, let's say a weight given by tau BF, that weights each fund's gain from trading with that bank versus each bank's gain from trading with that bank. So tau BF is the bilateral market power indicator. What I would argue is that in real life, this bilateral market power indicators probably have a very strong bank level and also fund level structure, meaning that if I'm a Fidelity market fund and I'm trading with JP Morgan, probably another fund trading JP Morgan are going to face more or less the same level of JP Morgan market power, and every bank I'm working with is going to have, again, there's a bank fixed effect and a fund fixed effect, and in your model you can even estimate this. Finally, each fund's and each bank's return is given by the quantity that they're bilaterally pledged to one another, the rate, and this idiosyncratic ad hoc component which says I, MMF Fidelity, really enjoy funding JP Morgan for some reason, and then JP Morgan really enjoys receiving funding from Fidelity market funds. So those are the epsilon and the xi terms that you see there in red. But what is market power when you also have these idiosyncratic preferences? It kind of works in a way, the context. Let me give you an example. If we're trading and I really enjoy funding your bank, then this might even make the model, I might even fund you at zero rate, just so that I can, let's say, fulfill this idiosyncratic preference. If you remove them, your model not only gets clearer in terms of what is market power, you can actually directly estimate, if my math is correct, some of the moments that you estimate in your paper by indirectly. You can estimate them directly just by controlling this. Now, in the interest of time, let me just congratulate you again, and it's a very interesting work, and looking forward to see next iterations. Thanks.
Thank you for your comments, Douglas. I'll now open to questions from the audience before Paula can react to Douglas' comments. Someone? Paula, please feel free to react. Take your time. Yeah, when you start, you will.
All right. Thank you so much, Douglas, for the very nice discussion. On the first comment on the treasury market, in the model, we assume partial equilibrium in the sense that treasury rates are exogenous. And as such, of course, what we can do better is to make it endogenous and see the spillovers from one market to the other. With Iñaki Lazaro, we're working on something similar in the vein of a general equilibrium model with a treasury market to see further question, but we could potentially use that technology in this context. And indeed, that parameter on aggregate risk, it's important for the allocation. And notably in the paper, our assumption is that treasuries are indeed subject to aggregate risk, capturing what you were saying, that indeed in times of distress, the treasury market is also under distress. But I'll look at the specific impacts of that key parameter on aggregate risk aversion to see how sensitive the results are. Then in terms of credit risk, it is true that we see CDS increasing for banks during COVID. That parameter in the model on idiosyncratic risk, an increase in that parameter would imply an increase in cost in funding provision for funds, but that would increase, and we have done some exercises where we see that increasing that concentration risk would actually imply larger impacts in terms of the distribution of bilateral rates. But it's true we could try to see how credit risk, and perhaps as using some of the shifts that we saw during March 2020 to see how the model does. It does a better job when you increase that parameter, but I will see how sensitive it is to actual changes that we see in the data. And then in the bilateral trading motives, in the model, those are thought from the perspective of bilateral relationships, as you said in your discussion. But more importantly, for the calibration, for us to be able to calibrate the exact distribution before March 2020, we use both trading motives for banks and funds. But it is true that those could capture, for example, the dynamic relationships of money market funds and banks and how they choose endogenously the network. I haven't done much in terms of making it more simple as to make it zero for everyone, because essentially the dispersion across counterparties is going to be much lower and before the counterfactual. So for realistic reasons, we have it in the paper to be able to match the exact distribution of prices before the crisis. Yeah.
So more questions? Someone else from the audience? So thank you, Paula, for your presentation. I invite now Douglas from the BIS to present his paper.
Hello again, everyone. Okay, thank you all for the presence and for being here presenting this paper. This joint work with Fernando Linardi, who's there, and with Luis Otávio Visotto, who's not here, is actually presenting another of his works in another event. And it's a pleasure to be speaking here. Of course, this is a BCB data, a BCB setting inspired paper. The idea here we're looking at is we'll look at supply chains in Brazil. And then we leverage the fact that the country is really, kind of has continental dimensions. And then we explore the fact that each geographical area is potentially under different, climatic event. Some of them are anomalous, or let's say extreme or moderate shocks. And then what we do is we estimate, okay, if I'm sitting in Brasilia, and let's say I have a firm, and I have a trade connection with another firm elsewhere in the country, if they are living under some climate shock, climatic anomaly, what we discover is that my firm or my economy here in Brasilia will also suffer the impact. So this is the paper in a nutshell. And the reason why we use Brasilia data is that it's actually, we consider it a very good laboratory for this type of climatic studies or climate shocks kind of risks, because it combines a lot of different things: continental size, variation, both along geographical lines, but also socioeconomic variation. Virtually all of the shocks of all of the major events that we have in Brazil, they are related to climate. For example, we don't have a lot of earthquakes or volcanoes, so they're all related to climate in a way. And there's an immense availability of granular data sets. And in this case, for example, what we use, we look at data at the municipality level. We have 5,570 municipalities. And then we look at these connections, leveraging the fact that here in the central bank, because the payment systems is overseen by the central bank, we can actually see firm A sending money to firm B, so we can look directly at these trade connections, okay? And what we find is that if we are here in Brasilia and we have a local climate shock, then obviously our economy here will grow less. If we have a trade connection with another city and they have a climate shock, we are also going to grow less, okay? And in fact, what we show here in the paper is that there's not only GDP, but also we look at other data sets, we also see an effect from depressed economic activity. And we also find that this effect is heterogeneous. So the effect will depend on whether or not my economy is more agriculture related or more manufacturing, more service related, okay? And not only this, but also we find that we do an exercise at the end, if we have time, happy to present, that these supply chain connections in Brazil, they're not only responsible for shocks, but also from shocks that can be attributed to the recent change in climate, okay? So because of time, I'm gonna jump to literature a little bit. Again, pretty much all of the disasters that we have in Brazil are environmental in a way. So here, this list, the geologic, the pink line, you barely see it because everything else is either strong rains or strong drought, okay? In terms of climate data, what we do is we use satellite data. We use grid data about precipitation and temperature. And what we do, we create this index that is widely used in the financial, the physical climate, so the geological, geographical research, where they do what is called a standardized evapotranspiration index. And what this index tells us is the intuition is simple. For a given city like Brasilia, how much did it rain in 1 year compared to the historical average? And we use data going back all the way to 1960. And then it's standardized, meaning that the number is actually zero mean, and it is given in standard deviations compared to Brasilia's own historical mean. And we do this for every municipality in Brazil. Okay, and then we call everything that is more than one standard deviation above or below its -1, the historical mean, we call it a climatic shock, a climate shock. If it's between 1 and 2 standard deviations, or -1 and -2, we say it's moderate. But if it's 2 standard deviations in either tail, we say it's an intense shock, okay? So we break down the shock intensity in a way with this threshold. And so here's a graph of what we find across all municipalities. The vertical scale is the percentage of Brazilian municipalities suffering each type of shock. And the red bars are the dry spells or droughts. And the blue bars are the wet spells, or when you have a lot more rain than that municipality is used to seeing throughout history. What we see, the frequency changes over time, the type of event changes over time. Of course, most of them are moderate, as you would expect. But we also have some intense shocks occasionally. And what we do then in this paper is to really just, we exploit this geographical distance to regress GDP growth in one city against the percentage of its trade partners that are suffering any of those climate shocks. Okay. So I mentioned the payments, so let me jump this. So this is our baseline equation, okay? Now just to say how we measure the local shocks, just to set a baseline in terms of number of size of effect. So Y is our GDP growth measure for municipality I in year T, and then we'll also look at, this eta here is the climate shock for that city, okay? And then the climate shock can be dry spell or wet spell. And what we find in this regression is that, these local climatic shocks, they depress local GDP growth. And again, this is just the baseline. We're going to get to the supply chain effect. And the effect is quite significant. So for example, in a given city, people that live here in Brasilia, like I have for a long time, know that sometimes we have, strong dry spells, strong droughts. This depresses economic growth by 1.7 percentage points per year, okay? Now we're going to look at the interesting part about the supply chains. So now controlling for past local growth and local shocks, we look at the shocks occurring in each of its trade partners. Okay? And actually, so before I go there, one of the ways we identified this is that, of course, maybe if we're just comparing to trade in a city close by, maybe they have even the same climate. So it's kind of correlated. So what we do is we take only very distant cities to show this effect happening, okay? And what we find is that, oh no, sorry, this one is just breaking down the intensity, and I want to show that the moderate aspect of the shock is actually, it corresponds to the bulk of the effect at the local GDP. So it doesn't have to be a super intense climate shock, the one that appears in the headlines, to drive these negative GDP effects, okay? So sorry, I jumped the gun. Now we are indeed coming to the supply chain transmission. And the equation is a bit more complicated, which is why I wanted to present you the baseline. So here's what we're doing now. We have the GDP growth at a given municipality I and year T, and controlling for past growth, for time and municipality fixed effects. And for the local climate shocks, we then look at what is the effect coming from shocks in customer, so municipalities with customer firms, those that send you money, and municipalities with supplier firms, those you send money to, okay? And this is a weighted regression in a way that, so this omega weight that you see there, it's a weight saying that if it's 1, all of my customers or all of my suppliers are suffering a climate shock in that given period, okay? And then the eta equation that you see there is the actual climate shock for municipality J, different from I, in this aspect. Okay, as I said, when cities are close by, maybe their climate events are correlated with my own local events. So this would be, let's say, this would mark the identification in a way. So what we do is we take every bilateral connection between municipality firms, and we take the median. And the median distance is 573 kilometers in a way. That's roughly the distance between Brasilia and Belo Horizonte, or Basel and Amsterdam, or if we're from the US West Coast to Los Angeles and San Francisco, for example. Which means that they don't share the same climate. It's actually pretty far away. And so what we don't show here, but when we run regressions without this cutoff, distance cutoff, actually we get the same results, which is good, but we just focus on this geographical identification, spatial identification. So if we focus on the center of the planet, Belo Horizonte, for example, and we draw a line with this radius of 73 kilometers, we see that only municipalities outside of the circle are considered in the equation for my supplier or customer climate shocks, okay? And now, for example, in Basel, where I live, if we draw this, we essentially have a country fixed effect, if we're talking about a European data. Okay, so what we find, give you a glimpse before showing you the regression, is that the bulk of the, well, first, there is significant transmission of climate shocks through supply chains. So my GDP grows less if I trade with them and one of them has a climate shock. And this happens mostly through customer municipalities whenever they have a dry spell, okay? So if my customer is going through a drought, my GDP grows less, okay? And interestingly, this is more or less the same effect as the local shock, which suggests that the transmission is actually pretty strong if all of my customers were undergoing the same climatic shock, okay? And then, okay, we also estimate, with all the shocks happening at the same time, I'm going to show you that this takes away the statistical significance, but there's a good reason, and then we have robustness to show that the effect actually exists. So here's the equation. I wanted to present the results before going into the numbers. The first 2 rows are the local effects, my wet and my own dry spells. The next 2 rows, they are what happens when my customers, they are also undergoing climate shocks. And then the last 2 rows, we have the supplier effects as well. What we see is that the main transmission occurs through customers. And as I said in column 7, if we put them all together, the effect kind of goes away, but this happens because when we look at the data, oftentimes firms, they have both customer and supplier relationships with the same city. So this correlation kind of bumps up the standard variation of the index. One of the interesting things that we thought is that because our definition of shock is based on a normalization So everything is zero mean divided by its own standard deviation. We can actually break down into moderate and intense shocks, like we discussed. Which of these components of a shock, the moderate or the intense ones, are more responsible for this supply chain transmission? We find actually that moderate shocks, they are strongly, kind of related to this supply chain transmission of climate shocks. Of course, they are more frequent than intense shocks, thankfully. And their magnitude is also big, even when we're regressing both at the same time. It means that intense shocks, of course, they are also transmitted as well. But the moderate shocks, again, the ones that maybe are not declared as disasters or do not appear in the headlines, they also contribute to another municipality's lower GDP growth. Okay, but how exactly? And is there other compelling evidence? Because it is, arguably kind of a tall ask we know that shocks, of course, impact locally, but then to say that they transmit with the same intensity to other municipalities, you need, kind of supporting evidence. So what we do is we look at other data sets as well. We look at each municipality's export and import activity, and we also look at their labor markets to give us other indications of, what could be going on. So we take this customer dry spell, which, as we saw, is the main, let's say, channel through which climate shocks transmit in supply chains. And then we then look at its effect on all of these variables, controlling for local GDP, local X variable, just adding a bunch of controls. And what we see is that if we are in Brasilia and, some of our trade partners, of our trade customer firms elsewhere in the country, they have their own climate shock, then my export does not grow, but my economy actually depresses a little bit in the sense that my import activity is lower. Overall payroll, meaning the sum of everyone's wages in the city, falls. The average wage falls and employment falls, meaning, those are all strong indications that something, kind of the city's economy feels whenever its trade partner elsewhere has this climate shock. And then because they are correlated in the sense that maybe let's say the three are close by municipalities, let's say one of them is my customer, the other two are suppliers. When I just put them all together without addressing this potential correlation, then the uncertainty kind of takes away the statistical significance of the effect, as I showed you. But if I control for this, adding those interactions actually comes back with the same magnitude overall, which again, another indicator that even when we pull all of the shocks together in the same equation for all this data, then we have this effect, surfacing again, revealing itself again. And interestingly, foreign trade, does not amplify or offset this effect, meaning that my GDP does not fall more or less if I have a customer and then I can replace the customer that is suffering a shock with a customer outside of the country, or it does not amplify, meaning that it's hard for municipalities to diversify away from this risk. Okay. But they do try. When we look at a shock at each municipality's their Herfindahl index of concentration, of diversification index, what we see is that whenever they suffer a shock, actually both their customers, so they try to diversify the number of customers and suppliers as well, meaning that it's something that municipalities feel. The economy falls locally, it grows less, it's a bit more depressed, and they try and adjust for this by having trade with more municipalities or having less concentrated trade exposures to just one municipality. Okay, one important effect, of course, the economy is not a monolith. There's a lot of heterogeneity, and one of them that is particularly important for Brazil is let's say, this broad sector heterogeneity. We have a very dynamic agriculture sector. We have, of course, manufacturing as well, services, and how do they all respond to these shocks? Spoiler alert, very differently from one another. So just focusing now to set the stage for this sectoral analysis, we look at the local effects from local climate risk at each of those sectors. And as I think probably almost everyone would expect, agriculture is more sensitive to local climate shocks. Manufacturing is also sensitive, but much less than agriculture. And services is, a bit less sensitive. Okay, but now when we take this to supply chains, what we see is that agriculture GDP, it really kind of it remains sensitive to supply chain transmitted climate shocks. Okay, manufacturing as well, but interesting from another sector, from supplier dry spells, not from customers. And services actually is very resilient to supply chain connections, meaning that services GDP falls when the shock is local, not as much as agriculture, not as much as manufacturing, but it basically does not respond to supply chain shocks. Agriculture GDP responds a lot. And then, of course, the effect that I showed you before is more or less a weighted average of all of this happening across Brazil. Okay, so now that we saw that climate shocks, they impact the local economy in such a strong way that this is actually transmitted to trade partners in a heterogeneous way, depending on each economy's local configuration in terms of broad sector distribution. We then do the following exercise. We want to look at, okay, now that we saw that this channel is it's important, it's meaningful, what can we tell about its potential to spread climate change losses? So losses from the change in climate compared to what it could have been before. So a bit more equations here. It boils down to, we look at data from the 60s all the way until 2011, when before our network data begins. And we calculate a linear trend for both precipitation and temperature. Okay, so this was what climate could have been based on historical trends. And then we calculate the shocks, the anomalies, again using that SPEI indicator that I showed you before. So this is the counterfactual, the climate as it could have been following historical trends. And then we do the difference between what we actually saw and what it could have been if it was just following a linear trend from history. The difference we interpret as the climate change. I mean, we're not taking a stance on whether it was human-made or et cetera. We're just saying that it's different from the historical trend. And then what we find is that actually we take this customer dry spell, plug in the network, and then we do the difference between my own customers' actual dry spells minus what it could have been under this historical trend. And we find that most municipalities, the vast majority, would have up to 1 percentage point lower GDP growth, just on account of this difference. Well, again, what we say climate change, without taking a stance of it's harder or the direction. We're just saying what it is now compared to what could have been following historical trends. So we find that climate anomalies, they impact both local and remote growth, and the later through supply chain connections. Those are by any means not the only channels it could have been. I mean, there are other channels like tourism, or like, maybe they have commonality of firms, of banks. Supply chains are the channel we explore, and we find them to be meaningful. Moderate events, moderate climate shocks also matter. Okay, so it doesn't have to be a big disaster that appears in the headlines. Also, going deeper down, the customer dry spells, they are particularly important for this transmission overall. We find significant heterogeneity, and these supply chains are actually important also for the transmission of negative effects that come from climate change. So thank you all very much for your attention. I'm looking forward to the discussion and comments.
Thank you, Douglas. Matthias, go ahead.
So, let me start by congratulating Doug and your co-authors, because the paper is really nice. There is so much effort. I mean, many of you have seen this probably. to try to pin down the effect of climate change, right? And I think we have come to a point now in the literature where we need to mature and narrow down the discussion to specific channels that can be potentially a target for policy action, and this is where I see this paper contributing to. So it's not only about, you know, saying that we find some effect of temperatures rise or droughts or, you know, floods. It's more about identifying specific mechanisms, economically intuitive mechanisms that can be a target of policy actions, of regulatory action, of supervision. And this is where the paper makes, I think, a great contribution. I prepared a super nice chart to summarize your paper. Let's see if you like it. So basically, what the paper does is to identify two types of effects of extreme weather events in Brazil. First, direct effects. So these are shocks occurring in one locality. These are municipalities. As you know, Brazil has some 5,000 municipalities, I think, and in the sample they have 2,000 because this is how you narrow down the sample once you incorporate banks, right? These are the municipalities where you have banks. And this is the direct effect. So it's the on-site effect, right? But most interestingly, the paper will focus on an indirect effect. This will be a sort of network effect. It's not called like that in the paper, but that's one way to see this, right? And here, this is the second bucket in the diagram, you will have the same climate shocks, so wet and dry climate shocks, affecting two other municipalities that I call here B or C, which are suppliers or customers. So these are different regions, different municipalities where the customers or the suppliers of municipality A are located. And what the paper argues is that in both cases, GDP of municipality A will drop following these shocks, either local shocks or shocks abroad. Abroad, not in our countries, abroad within Brazil, but in other municipalities. Two further results that I really like. One is the diversification effect. I mean, I know this comes as an extension in the paper, but I really like it because it puts a lot of economic intuition on the results. Basically, what they find there is that the municipality A becomes more diversified in terms of customers and suppliers after facing these events. So that's super interesting if you think about how agents are reacting to this type of situations, right? And second, the effect is stronger for agricultural GDP, as Doug was showing at the end, the results of this very nice exercise towards the end of the paper with the simulation exercise. So lots of interesting results. I really like the paper, and to focus a little bit more on the identification, this is what they do, right? This is the main regression. You have three main coefficients, one for the local economy, one for the customer municipalities being affected by shocks, and one for the supplier municipalities being affected by shocks. Again, think that the shocks can be either wet or dry. And at the same time, they can be either intense or moderate. So it's a sort of 2x2 matrix in a way of if you want to make a typology of the type of effects that are pinned down in the paper. So this is the way it works. It also controls for some fixed effects. And the main results summarized here are first that local dry spells locally lower GDP. So if you have a drought in your municipality where you live, you will see that GDP will drop. This is contemporaneous, so it's on the same year. Second, dry spells abroad in other municipalities will also lower GDP, particularly when they affect customers. Okay, so these are people that are like downstream in the supply chain, below you, those guys that you are selling goods. So if they get affected by a drought, then you will become, you know, shocked in your own producing municipality, right? And finally, the effect is led by agricultural GDP. At the same time, manufacturing GDP in the core municipality decreases when the dry spells affect the suppliers. So there is actually also an effect on suppliers. It's only that this is kind of more narrowed. So not in magnitude actually, but in terms of how we should think about this. 4 ideas to discuss. So first, the economic interpretation of some of the results. So I really like the results. I believe in them. I think this is well crafted. So it's more about trying to frame some of the findings. Second, the discussion of moderate versus intense. I have some comments on that. Third, ideas on how to connect this with some recent literature that may provide nice insights that can, I think, motivate some further tests. And finally, some metrics if the time allows. So first, interpretation. So I like the results, I believe in them, but at the same time, it's sometimes a bit hard to think about specific examples. So imagine, I think you got already the message, right? So there is another municipality being affected by a drought, and your agricultural GDP as a producer will drop, yeah, when your customers are the ones being affected. So it's like you're producing, let's say, tomatoes, right? And you're selling them to another municipality. And what matters is, on the one side, obviously what happens in your municipality, because that affects the production of tomatoes, but what matters, and what is most interesting in the paper, is that if another municipality is facing a drought, your production of tomatoes will drop too, right? This is obviously interesting. What I was thinking is how we should think about this result. So some possible mechanisms that I had in mind, one is obviously the most intuitive one, a demand shock, right, that is propagating upstream. But I would like to see maybe, Doc, some examples or some ideas. This could be also like, you know, some very simple evidence of some examples of firms that are being affected in this case, just to try to help the reader to understand how we should think about these agents that are, for some reason, selling goods and being affected by climate shocks that are not in their own locality, I mean but also by shocks that are occurring in other regions. Also relationship traits or stickiness. So I was thinking maybe what matters here is that if there is a producer that has a sticky relationship with a client and it cannot really replace it, so the elasticity is pretty low, maybe that could also provide an explanation. And that connects obviously with this diversification test, right? So maybe there is a way to connect those results that come to the end of the paper with the main message. And also joint production. Despite the fact that you look at distant municipalities around 600 kilometers away from each other, still agriculture may involve inter-municipality coordination, right? So for example, joint production. You may own a farm and your farm has different production locations across your federal state, even at longer distances. So if that's the case, maybe there is also a way to better understand what is going on here. So deriving testable implications is basically the message. Moderate versus intense shock. So when you read the paper, the authors, they put a lot of emphasis on saying that the results seem to be driven by moderate shocks instead of intense shocks. And there is some evidence indeed in line of this. I had two comments on this. So first is that I was not convinced by the empirics that this is necessarily the case. Sometimes the magnitude of the stronger shock, of the intense shock, are larger, sometimes not, sometimes one is significant, sometimes not. But most importantly, obviously, this is a bit puzzling, right? So we will expect in principle, just abstracting from the paper in theory, that intense shocks should matter more than moderate shocks, right? Can we think about ways to solve the puzzle? Yes, sure. And I have here a few alternatives. For example, you may think about the response to these shocks. You may think that when you have an intense shock, governments intervene, even private actors, and that moderates the overall spillover. That could be one idea, right? Another one is a statistical artifact. So it could be the case that simply because we have so few of these large shocks, eventually they cannot become visible when you run the regression. That's a possibility, right? And the most interesting one, because this connects with people that are working on related papers, is persistency. Maybe moderate shocks, although they are smaller, they are more persistent. It's an hypothesis, I don't know. But if this is the case, if you have a repeated game, maybe eventually the moderate shock becomes more damaging, right? And there is actually some evidence on this in the literature. There is a nice paper by Paula Bustos from CEMFI. It's not published yet, it's a working paper, very related. So they also look at Brazil, also at climate shocks. They don't look at trade relationships, but they do look at production. And they find two things that I thought were nice takeaways for Doc and for his co-author. So one is that in their paper, excess dryness, what they call excess dryness, indeed has an increasing impact, a non-linear increasing impact when you move right in the distribution of shocks. So larger shocks have more impact. This is also an indirect shock, by the way. So it's also computed in a network structure. And second, they find very strong evidence for migration outflow across Brazilian municipalities. So when a municipality is affected by one of these shocks, people migrate eventually, particularly when the shocks are persistent. That's why I come back to this idea. So maybe why should I think this is interesting? Migration, you don't explore this yet, but could be an explanation for how this demand shock is unfolding. So we may see a situation where the guys buying the tomatoes, either firms or households are migrating out of these affected regions, and you as a producer suddenly use your customer, right? That's a plausible explanation. And the nonlinearity on panel A is certainly also something to consider. I'm a bit out of time, but let me try to cover two slides more. One is also connected to the last point. This is also a graph coming from the paper by Bustos. So when you look at drafts across Brazil, you see that there is this very strong focus or clusterization of drafts in the Northeast. You know, guys, much better than me what is special about the Northeast. I was Googling around, and what I found out is that this region seems to be particularly high in terms of poverty. Banks are a bit more widespread. There is not so many banks around. And at the same time, it's a region that produces a lot of agriculture. So I was wondering if this can play a role. So are the shocks kind of specially clustered or not? And does this play a role? Even if you consider the 600-kilometer distance, maybe within that state, there could be a case for cause shocks, like shocks that occur simultaneously across the supply chain and affect the whole supply chain simultaneously, irrespective of how you measure this. So that will be like a concern. There are solutions for this. I will skip them just in the interest of time, but the most meaningful one is introducing region and time fixed effects to try to address this is possible. A comment very briefly on the metric, if you give me a minute, Chair. So alternatives for this idea of intensity versus moderate shocks. So I kept thinking about this because I like, in principle, the idea of approaching this and touching upon this important issue. So something I was a bit concerned is that my impression as a reader was that always when you have an intense shock, you have by definition also a moderate shock. Like one is nested in the other, right? Because of the definition, because you have a shock that is one standard deviation beyond the average and otherwise two standard deviations. And the paper kind of assumed that there is some sort of additivity between these two variables in the same model, but at the same time, you can think about many nonlinearities and nested structures that are being ignored. And alternatives exist. So one alternative is the one that Bustos implement with a quadratic term. So simply, basically, you add an interaction of the exposure times itself, right? And then you plot the effect all across the distribution. That's panel B here in a simulation that I conducted. And in the third panel, you see another alternative, which is including an interaction term between, did I say it right? Yes, so an interaction term between the two types of shocks. So instead of including them separately in the model, like moderate and intense, you try to pin down some joint effect. And that will maybe allows us as a reader to see better how this joint effect unfolds. One final element, I will not read all of this, just one, is more conceptual maybe. I was not fully convinced about the use of the word supply chains. I know this is very popular now, but at the end we're looking here at commercial buyer-seller relationships, which is true. I know there are papers that have used this data and used the concept. As a reader, I had the feeling that I was missing some elements that you see in this literature. For example, production sequencing, dependencies, input-output relationships, and things like this. Maybe this is well captured in the definition, but maybe one way to go around this, in case you get a referee that is too much involved in the supply chain literature and gets mad at you because you are using his concepts, is to try to provide some context for the definition and say, hey, so this can actually capture also input-output relationships as we see in the literature, so on and so forth. So that could be something to consider. Overall, super nice paper, tackles a very important question. I encourage you, particularly being many of you a Brazilian audience, to read it. My recommendation is to focus a little bit more the exploration of a few important patterns and provide intuition for this. With that refinement, I think the paper is in good position to provide a very significant contribution to the literature on climate risks. Thank you, Dora, and thank you, Chair, for the extra minutes.
Thank you very much.
Thank you, Matthias. Now we are open for questions from the audience. Someone, please. Go ahead.
Great paper. Congratulations. I'm curious, if you have in mind one case which you can explain, of an upstream supplier and a downstream consumer, because for me it's puzzling that if I'm an upstream supplier and one of my consumers have a shock, how can I just, I'm selling a tradable good, how I just don't shift my sales to somewhere else, and everything is just a price effect. So again, do you have this in mind, example of product and example of downstream consumer? And the second question is, again, related to policy applications, is when you run a regression, if you're not just capturing the marginal effect, but the question at the end, what's the overall effect of those shocks over a year? Because again, it seems to me that the overall effect in the end will be actually quite small, because again, you're estimating marginal effect, but if I have 10, 50, 100 clients all spread over Brazil, and if one of them has a shock, of course, there's going to be a marginal effect on my revenue, but the overall effect will be nothing. So I was wondering if you have that number, that back of the envelope calculation, to say like, this is how much actually companies got affected last year based on all those shocks. And the final comment is also related to the discussion's comments about the moderate effects. It could be the case that the moderate effects is actually capturing these long-term change or middle-term trends. And that's when you work with climate change, the first thing that you have to do is have to basically have this moving average to make sure that you're capturing those trends as well. Right, but great paper anyways.
I'll open for one or two more questions if you have. Someone else from the audience? I have one kind of a comment or a question. I think I agree with some of the points brought by Matthias, and I was taking a look at the paper, and it looks like in one of the first tables that you look at at GDP growth at municipality levels, and I think it's nominal. You have in your model time fixed effects that are going to capture the inflationary trends in the country, but maybe some of the results, not when you're looking at employment or something else, but when you're looking at GDP growth, part of that might be reflecting changes in deflators that are related to particular locations, and that might be important, particularly for agriculture. I think the point of 500 kilometers, they are far apart, but maybe for the relevant, maybe there are not severe droughts, but there are widespread droughts that might have impacts on agricultural crops in a large area. So maybe one way trying to think with Brazilian peculiarities in mind is to think, maybe look at your data set and focus on shocks in agriculture, in some agricultural regions of the country, and how some other places react. Instead of looking at, it's good for someone else to think about, 500 kilometers is the limit you have, but maybe you can try to think of places that are affected by a lot of those shocks and how the supply chain reacts. So it's this question about nominal GDP growth, and it's more a suggestion. And the other is also, I think, more a suggestion than a question, sorry. It's about when you look at the effects, and you mentioned in your abstract the lower growth is something close to 1 percentage point. And I know that you are talking about the mean effect in the cross-section of municipalities. But for me, working as a macroeconomist, it's very intuitive to think about the aggregate national GDP growth. And I think it's not that. So maybe it would be nice to look at some weighted average effects according to the local GDP, to think what's the aggregate country effect for Brazil of those shocks. 1 percentage point, it looks like a lot to me. Maybe it's more important in smaller municipalities or something like that. It would still be super relevant if it was 0.2% on some aggregate measure. Just those comments. Go ahead. Douglas, please, go ahead to answer.
Yeah, no, thanks very much, Matthias, for this excellent and in-depth discussion. Also to the colleague there asking the question, and Ricardo also for these questions. So, okay, so let me start one comment here, just in this aspect. I think those are very interesting suggestions to calculate kind of the policy implication, the overall effect. When we say 1 percentage point, we have municipalities that range from São Paulo, which has more people than in many countries, even Switzerland. And they have municipalities that have a few thousand people that live there. So we're talking about very different levels. And then, of course, yeah, I think just a weighted average would be a good way to convey the policy importance, the overall relevance of this. At a nationwide level, although I would argue that this average effect, of course, we have this whole distribution of municipality sizes. 1 percentage point is important for each municipality itself, right? So even if the aggregate numbers, they might point to slower numbers, the fact that overall, exploring all this variation, we find this effect, it means that it's important locally as well, right? On the example, I think it's an interesting question. We've been asked this before. One example that, just out of the top of my head, I don't know if this is really what's in the data, but just to illustrate the type of thing that could be going on. So let's say you have one municipality that, what they do is that they raise poultry. In another municipality, they plant corn. And if you have a drought, then, let's say, or some other type of climate shock that kind of, for example, may depress the yield of the poultry, they might grow less, they might die more from, let's say, heat stress or dehydration, then they will buy less corn from the other municipality. Okay, and the effect on prices is kind of more complicated because in Brazil, many of our agricultural products, they're actually traded globally, and the price formation is global. So it's there might be more of a quantity effect in each municipality specifically. So obviously there's a lot of things to discuss, and I'm happy to follow up bilaterally, but just in the interest of time, let me pick another topic here. So the example, the aspect about the moderate shocks, it's not a hill we die on, it's just something that it called our attention when we were first doing this exercise, that we thought, if each municipality's climate conditions is standardized for that particular municipality, and some of the shocks, they go beyond 1 standard deviation. I mean, 1 standard deviation or -1 is not a lot, right? So this is our intuition behind saying some of the shocks are moderate, some are more intense. And initially, when we first started looking at this, we were using declared disasters data set. So each municipality, they can declare disaster. And then they receive federal funding, which actually goes to your point that, maybe some of the lower effects from the intense shocks is because they receive funding. We ultimately chose not to use this data because if you think about it, municipalities, they have an incentive to declare disaster depending on their own financial conditions. There's another paper that shows that this happens. So we said, let's go with physical, hard data, precipitation and temperature, because you can't game that. So this is how this whole story about the moderate and intense shocks was born. There's a lot more shocks going on, like in some years up to 40% of all Brazilian municipalities are suffering some type of shock, but not all 40% of municipalities are declaring disaster. So this is how the moderate story was born. And we thought because it's standardized, and of course we fully acknowledge there might be a lot of nonlinearities going on between moderate and intense shocks. But in the end, we're talking about a 1-year window. So it's not as if, it's a small drought, but then it becomes intense. No, if it's an intense shock for that year, it's an intense shock, right? And then those thresholds, they were kind of, we decided the thresholds based on what we thought was intuitive, like a 1 and 2 standard deviation thresholds. But of course, people are always kind of welcome to let's play around with the definitions themselves, etc. Having said that, all of those questions and comments, excellent pointers for further thought as we continue to kind of explore this space. And just a final comment on the supply chain. We noticed after we started presenting this paper that the word is loaded. For some people, supply chain is a very, very specific thing, like a value chain away. For other people, like me personally, if a firm is sending money to another firm and it's not a bank, they're buying something, and they're not donating. And if they're buying something, it's because they needed to produce something, right? So this is my intuition. So overall, even though, of course, we could have been more nuanced, I would counter-argue that the bulk of those transactions, if not virtually all of them, are indeed supply chain related, especially because we sum across the whole year. So even things like, just sporadic accounts. And we also have a threshold where everything below 10,000 reais, so $2,000, $1,500 is taken away. So even like sporadic purchases, a lunch in a restaurant, they're taken away, right? Hopefully, but and then all the remaining are more like supply chain type of things. And the shocks are also value weighted, meaning that if people in Petrobras, they buy machine products from a company, and they occasionally buy a very expensive lunch for its officers, because it's value weighted, we would capture this in a way. So I hope this addresses your comments to some extent. Thanks.
Thank you, Douglas. We have time for one more question in case someone wants. Well, I believe today we have a shy audience. I'm sure the authors will be, you can take a look at their faces, they will be very happy to talk to you during our coffee break if you have questions or suggestions. I want to thank the three of you for submitting your paper to our conference and to coming to Brazil to present the paper. Thank you very much in the name of the Central Bank, and I'd like to ask everyone for one last round of applause for them.
Thank you.
Thank you, Ricardo. Very nice chair.
I think